We kick off today's deep dive with a story that cuts right to the heart of where the American consumer actually stands heading into the second half of the year. The Federal Reserve's latest beige book, the Fed's own qualitative temperature check on the economy gathered from business contacts across all 12 districts, flags something both encouraging and deeply concerning at the same time. Yes, the World Cup soccer tournament gave bars and restaurants a visible, measurable lift in foot traffic and revenue. But that boost was narrowly concentrated in hospitality venues, and it is not translating into anything broader. That is the warning signal hiding inside the headline. The Federal Reserve's beige book, released as part of its standard pre-meeting economic assessment, explicitly noted that the World Cup tournament provided a temporary lift specifically to bars and restaurants, but that the boost was narrowly concentrated and not translating into broader consumer spending or economic growth. This is a qualitative survey, not a hard data release, but its language is precise and deliberate. Fed district contacts described consumer momentum as fragile. This is not a small distinction. Markets had been pricing in resilient consumer spending to justify elevated equity valuations. That confidence is now being questioned from inside the Fed itself. Here is the macro transmission that matters most. When the Fed's own survey describes consumer strength as episodic rather than sustained, it signals that the underlying demand trajectory is weakening beneath the surface noise of one-time events. Prior beige books had already painted a picture of regional divergence. This edition confirms that pattern and sharpens it. The concern for markets is that consensus expectations for sustained consumer growth may need meaningful downward revision. If the primary engine of U.S. economic expansion, personal consumption, which drives the majority of GDP, is only firing during World Cup weekends, the Fed's growth forecasts heading into the second half of 2026 look increasingly optimistic and potentially disconnected from reality. Let's get specific about where this lands in portfolios. Discretionary and hospitality names face the sharpest near-term risk. XRT, the retail ETF, is exposed as consumer pullback spreads beyond event-driven venues. Cruise and hotel operators Carnival, Royal Caribbean Cruises, and Marriott International benefited from World Cup-adjacent travel demand. But if that demand proves episodic, their forward bookings narrative weakens. Healthcare faces pressure on the consumer discretionary side of healthcare spending. Meanwhile, the Nasdaq 100 is already down 1.12% today. That move reflects exactly this rotation away from growth-dependent valuations. The 10-year Treasury yield at 4.68% is the key financial conditions barometer here. Any move lower signals the bond market is beginning to price in that growth slowdown the beige book is flagging. There are 4 things to watch closely from here. First, the 10-year Treasury yield at 4.68%. A break below 4.50% would signal the bond market is pricing recession risk, not a soft landing. Second, the S&P 500 support sits near 730, which corresponds to approximately 7,300 on the S&P 500 index. A breach there opens a test of the next structural support. Third, the VIX is declining today, but do not mistake that for complacency being safe. A spike above 20 would signal institutional demand for hedges is accelerating. Fourth, watch for any subsequent regional Fed commentary or hard retail sales data that either confirms or contradicts the beige book's qualitative warning about consumer fragility extending beyond the hospitality sector. Here is the single most actionable takeaway from this beige book read. The World Cup bounce in bars and restaurants is a statistical artifact masking a deteriorating underlying consumer trend, and the Fed is telling you so directly through its own survey language. That favors defensive sector rotation. Think staples, utilities, and longer-duration treasuries, over growth-dependent equities and consumer discretionary names whose valuations rest on sustained spending momentum that simply is not showing up outside event-driven venues. The Nasdaq 100's 1.12% decline today is consistent with this read. Position accordingly. That is the one story shaping macro sentiment as we close out this session. Full breakdown is up. If this level of analysis is what you need to stay ahead of the market every single day, hit subscribe right now and tap the notification bell so you never miss a breakdown. We cover every major macro move, Fed signal, and sector rotation as it happens. This is the Research Desk, delivered daily. See you in the next one.